I've made a lot of mistakes in my life. I passed on buying Federal Express. I didn't buy Amazon when I should have. I held on to Berkshire Hathaway, a dying textile mill, for far too long. Just out of stubbornness. Charlie used to say I had a gift for turning $1 into 90 cents and calling it a strategy. But here's the thing about mistakes. I've made enough of them that I've started to notice something. The biggest ones almost always came not from buying the wrong thing, but from standing in front of opportunity with my hands in my pockets, waiting for more certainty. And certainty, in my experience, only shows up after the easy money is already gone. So today, you and I are going to sit down, no rush, no panic, just two people thinking clearly. And I'm going to walk you through what I believe are some of the last genuinely easy wealth-building setups left in 2026. Not get-rich-quick schemes, not lottery tickets dressed up in a press release. Real companies, real tailwinds, real honest risks. And I'm going to give you the same framework I've used for over 60 years to decide whether something deserves my attention, let alone my money. Now, I want to be clear about something before we go any further. I'm not your financial advisor. I'm not your broker. I'm an old man from Omaha who learned to read a balance sheet before he could drive a car and has spent the better part of 70 years making bets on American businesses. Sometimes I was right. Sometimes, like I said, I was spectacularly wrong. What I can offer you isn't certain. Nobody can offer you that. What I can offer is a way of thinking, a lens. And once you have a good lens, you can look at any company, any industry, any moment in history, and start to see it clearly. That's worth more than any stock tip I could hand you. So let me tell you about my lens. It really comes down to three simple questions. The first question I always ask is this: can this company survive long enough to be right? You see, a lot of wonderful ideas go broke before they get the chance to prove themselves. It's like planting a seed in the middle of a drought. The seed might be perfect, the soil might be perfect, but if there's no water, that seed dies, and perfect doesn't matter anymore. So when I look at any company, especially a young one, I want to know how much water they have, how much cash do they have on hand, how many years can they operate before they need to go back to investors with their hat in hand. Because when a company runs out of cash and has to sell new shares to survive, you, the shareholder, get diluted. Your slice of the pie gets smaller. It's not evil. It's just math. And it's math that works against you. The second question is there a river flowing in this company's direction? Not a trend, not a hashtag, a real structural, unstoppable current of money that is going to move whether the company is clever or not. I've always loved businesses that sit in the path of something inevitable. When I bought Coca-Cola, I didn't need a brilliant management team. I just needed to believe that people would keep wanting something cold and sweet on a hot day. That river has been flowing for over 100 years. Now, some of the rivers I'm going to talk to you about today are newer, and some of them are being dug by the federal government with billions of dollars of shovels. That's a different kind of inevitable, but it's still a river. The third question, this is the one most people forget, is the price honest? Not cheap necessarily, honest. A wonderful business at an outrageous price is still a bad deal. A struggling business at a tiny price might be the opportunity of a lifetime. I paid too much for things I loved, and I bought things I didn't fully understand just because they were cheap. Both mistakes teach you the same lesson. Price matters always. Now, let's talk about some specific companies. And I promise, if you'll stay with me through this, you'll walk away not just with names, but with a way of thinking about each one that you can actually use. The first company is called Beta Technologies. They build electric aircraft, full-size planes that take off and land vertically like a helicopter, but fly efficiently like a plane. Now, when I first heard this, I'll be honest, my first thought was that it sounded like something from a comic book I read as a boy. But then I started asking my three questions, and the picture got a lot more interesting. On the survival question, they've got roughly 3 years of cash on the books. For a company this young, that's actually decent, and they're not standing in the middle of the drought I mentioned, they've got water. Revenue is growing at around 30% a year, and they're spending heavily on what they call R&D, research and development, which for an early stage company is actually what you want to see. You don't want them buying yachts. You want them building better engines. Now, the river question, this is where it gets genuinely interesting. The FAA, which is the federal agency that decides what flies and what doesn't in this country, launched a program to fast-track certification for electric aircraft. There were 8 slots available in that program. Beta Technologies won 7 of them. 7 out of 8. I've been around long enough to know that when the government points it hard in one direction, money tends to follow. On top of that, they have nearly $4 billion in aircraft orders already on the books. UPS is a customer. They've got nearly 1,000 planes committed for purchase, and they partnered with GE Aerospace to extend their aircraft's range. These aren't press releases. These are contracts. But here's where I have to be honest with you, and I will always be honest with you. The price question is a hard one here. The company went public not long ago. It's already down about 50% from where it started. And the revenue, the actual money coming in the door right now, is tiny relative to the $4 billion valuation the market is putting on it. About $40 million in revenue is expected this year. That's the kind of math that makes my old CFO instincts twitch. This is a bet on the future, not the present. And bets on the future can pay extraordinarily well. And they can also go to zero. Think about how many electric car companies launched in the last decade. How many are still standing? Scaling a complicated physical product, actually building planes at volume, is a completely different challenge from building a prototype in a hangar. So if you're thinking about beta technologies, think of it the way I think about a small farm in uncertain weather. The land might be wonderful, the crop might eventually be extraordinary, but you better be prepared for a few rough seasons before the harvest. The second company is called Rigetti Computing, and this one operates in what they call quantum computing, which sounds so exotic that I almost expect it to come with a Latin accent. Let me see if I can explain it simply, because I think I can. Your regular computer, the one you're watching this on, works by flipping switches on or off, 1 or 0 millions of times per second. Quantum computers use a completely different kind of switch that can be on, off, or both at the same time. It sounds strange because it is strange. But what it means practically is that for certain kinds of very complicated problems, the kind that would take today's best computers thousands of years to solve, a quantum computer could potentially do it in hours. Drug discovery, financial modeling, code breaking, problems that matter enormously. Rigetti builds these processors themselves, which is a meaningful distinction. They're available through Amazon's cloud service. They have a contract with India's National Computing Agency. They've got a partnership with NVIDIA. And here's the river. The United States government has sent them a letter of intent for $100 million as part of a $2 billion initiative to build America's quantum computing infrastructure. When Washington decides something is a matter of national security, money flows. That's not an opinion, that's history. And I want you to hear this clearly, this is the most speculative name I'll mention today. They bring in about $4 million per quarter in revenue, and the market values them at roughly 700 times that. By every traditional metric I was taught to use, this number makes no sense. Now, sometimes that means the market is wrong and the company is extraordinary. And sometimes it means the market is wrong in the other direction. I've seen enough booms and busts to know that genuinely transformative technologies do eventually create enormous value. I've also seen enough booms and busts to know they take longer than anyone expects and shake out more investors than anyone. Plans for, if you're the type who can put a small amount of money into something, watch it drop 40% and sleep soundly, knowing the long-term story is intact. This might deserve a small place at the table. If watching a stock drop 40% makes you want to sell everything, this is not for you. And that's not a criticism. That's just honest self-knowledge, which is worth more than any stock pick I've ever made. Now let me talk to you about Oracle, which is a company I suspect you've heard of and probably underestimated. Most people think of Oracle the way they think of the old post office in a small town. It's been there forever. It's a little slow. It's not glamorous, but it keeps everything running. Here's what most people miss. Every artificial intelligence system, every chatbot, every image generator, every model being built by every company you've ever heard of needs a home. It needs servers, it needs storage, it needs the digital equivalent of land. NVIDIA makes the chips that power these systems, but chips need a place to live. Oracle is building that place. They've committed $50 billion to building data centers. They have a backlog of $500 billion in committed orders. That's $500 billion of work that people have already promised to pay them for. When I bought See's Candies back in 1972, I paid $25 million for it. $500 billion in committed revenue would have seemed like a number from science fiction to me back then. It still does a little. Their revenue is growing. Insiders, including the founder Larry Ellison, own about 40% of the company, which I've always taken as a good sign. And when the people running the business have most of their own net worth tied up in it, they tend to make better decisions. Their margins are solid. They pay a small dividend. The risk is execution. Oracle is making enormous bets, big bets. Made well, create fortunes. Big bets made poorly can undo decades of good work. And they carry a meaningful amount of debt to fund all this building. The interest on that debt has to be paid whether the AI boom continues or not. So this isn't a guaranteed story, but of the 6 companies I'm discussing today, Oracle is probably the one that sleeps best at night, in my opinion. It's not a lottery ticket. It's a large, profitable business that happens to be sitting right in the middle of one of the most powerful commercial trends of our lifetime. Let's talk about the 4th company, Dynatrace. The ticker is DT. And if you'll allow me one more simple analogy, I think I can explain what they do in about 30 seconds. Imagine a town where everyone suddenly decided to hire 100 new workers all at once. Some of those workers are brilliant. Some of them make mistakes. Some of them occasionally knock things over in the warehouse. Now, someone has to walk the floor and make sure everything's running right, catch the mistakes before they become disasters, and fix problems before the customers notice. That's Dynatrace, except instead of a warehouse, it's the software that runs entire companies, and instead of workers, it's AI systems that are now making decisions on their own. As companies rush to deploy artificial intelligence, the failure modes are getting more complicated and more expensive. An AI system that goes wrong can delete databases. It can make costly decisions automatically. It can create legal liability. Dynatrace monitors all of that and increasingly fixes it automatically. The fundamentals are genuinely solid. They have no debt. They generate real cash. Their margins are high, which tells me customers value what they provide and don't shop around for a cheaper alternative. They have a $1 billion buyback program, which means management thinks the stock is undervalued enough to spend company money buying it back. Revenue is growing, though not explosively, more like a reliable creek than a rushing river. The honest risk here is that this isn't a company that's going to triple in 6 months. It's more like a business that keeps quietly compounding. So if you need excitement, Dynatrace might bore you. And in my experience, the boring ones often outperform the exciting ones. Over time, the exciting ones just make for better stories at dinner. The 5th company is Tenable Holdings Cybersecurity. And this is the one I find most compelling as a near-term story, though for reasons that go beyond the usual sales pitch. Most cybersecurity companies build walls, firewalls, intrusion detection. They try to keep the bad guys out. Tenable does something different. They show you every crack in the wall before the bad guys find it. They call it exposure management. Their platform scans your entire digital presence, your cloud, your code, your AI deployments, everything, and tells you where you're vulnerable and how bad it is and what to fix first. Here's the business reality that I think creates the opportunity. Every company in America is racing to build AI-powered software. Every one of those deployments creates new cracks, new vulnerabilities, new places for bad actors to get in. And cybersecurity is the one budget line that companies genuinely cannot cut. You can delay a new product launch. You can postpone a marketing campaign. You cannot afford to tell your customers that their data got stolen because you were trying to save money. So this is a business where the demand grows. Whether the economy is good or bad, whether the stock market is up or down. The stock has been beaten down significantly, roughly 50% from its highs. The company is profitable. It generates real cash. Revenue is growing at about 10% a year, which isn't thrilling, but is consistent. And I look at this business and I think about what Charlie used to tell me. Sometimes the best opportunities are the ones where a good business has been forgotten rather than destroyed. The honest risk is that 10% growth is slow. And if you're expecting a moonshot, this probably isn't it. What it is, I think, is a solid business at a price that doesn't fully account for how much bigger the cybersecurity problem is going to get. Sometimes boring and undervalued is exactly the right combination. Now I want to spend a moment on the last company, because in some ways it's the most interesting to me, even though it's probably the least known. It's called 10x Genomics. They work in an area called spatial biology. And if you'll give me just a few minutes on this, I think you'll understand why I find it fascinating. Right now, when a doctor suspects you might have cancer, they take a small sample of your tissue and they look at it under a microscope. They can see the cells. They can see whether they look normal or abnormal. But here's what they can't tell you. They can't tell you what those cells are actually doing. Which ones are aggressive? Which ones are dormant? Which ones are communicating with each other in ways that matter for treatment? It's like trying to understand a city by looking at it from 30,000 feet. You can see the buildings. You can't see what's happening inside them. What 10x Genomics does is let scientists see inside individual cells at the molecular level, not just what cells are there, but what they're doing and how they're talking to each other. You can map an entire tumor and understand at the level of individual cells what you're actually dealing with. That's the kind of thing that could change how cancer gets treated. It could change how drug companies develop new medicines. It's real. And 10x is the leader in it. The numbers here have a turnaround flavor to them. The stock is down significantly from its highs, about 85%. The company has cut costs sharply. Margins are improving. They beat earnings estimates by a wide margin recently. Revenue is growing again after a period of stagnation, and they're launching a new platform the second half of this year called Atira, which is designed to take their technology from research labs into actual clinical settings where the commercial opportunity is vastly larger. They've also partnered with an AI company to combine their spatial biology data with artificial intelligence, which I think is genuinely interesting, because finding patterns in the kind of complex data that cells produce is exactly the kind of problem where AI is genuinely useful. The risk, and I want to name it clearly, is that turnaround stories sometimes turn around twice. Management teams that cut costs and restore discipline sometimes slip back into old habits when times get good again. I've seen it happen. It's not rare. And when a company is still valued at billions of dollars while the revenue picture is still recovering, you're paying for faith in management's discipline, which is a harder thing to verify than a balance sheet. But if this turnaround holds, if the new product works and the AI partnership gains traction, the upside from here is meaningful, and almost nobody in the financial press is talking about it. In my experience, that's often where the good opportunities hide, not in the headlines, in the footnotes. Now, I want to take a step back and say something that I think is more important than any individual company I've mentioned. Knowing that a company has a strong backlog or government support or growing revenue, that's useful information. But by itself, it doesn't tell you what to do. And I've watched a lot of intelligent people get that part exactly backwards. They spend enormous energy finding the right company and almost no energy figuring out how to actually behave when they own it. I've been investing for over 70 years. The single most valuable thing I've learned has nothing to do with accounting ratios or industry analysis. It's this: the investor's chief enemy is not the market. It's the investor himself or herself. The moment panic sets in, the moment a stock drops 30% and your stomach feels like it's full of cold river water, that's when decisions get made that can't be undone. Selling a wonderful business at the worst possible moment because fear felt louder than reason. That's how wealth gets destroyed. Not by bad companies, by good companies owned by people who couldn't sit still. Charlie had a phrase he used to use. He called it sitting on your ass investing, which sounds lazy, but it isn't. It takes real discipline to own something through the rough patches, knowing the business is still intact, and do nothing. Most people can't do it. Wall Street actively encourages you not to do it because Wall Street makes money every time you trade in nothing. When you sit still, the framework, survival river, honest price, that's what keeps you sitting still when everything in you wants to move. Because if you know why you own something, a 30% drop doesn't feel like a disaster. It feels like a discount. And let me close by telling you something personal. I grew up in Omaha, Nebraska. My grandfather owned a grocery store, and every week he'd order supplies, canned goods, flour, sugar. And he had a very simple rule. He'd only buy something at a price where, even if the price went down further after he bought it, he'd still be comfortable buying more. He didn't know anything about technical analysis or market timing. He just knew that if the goods were worth having and the price was fair, you bought them. And if the price dropped later, you thanked your lucky stars and bought a little more. That's all investing is. Really, it's my grandfather in the store. But instead of canned goods, you're buying small pieces of businesses. And the most important thing isn't which business you buy. It's whether you paid a fair price and whether you can stay calm when the price tag changes tomorrow. These 6 companies, Beta Technologies, Rigetti Computing, Oracle, Dynatrace, Tenable, and 10x Genomics, represent 6 different bets on 6 different futures. Some are riskier than others. I've been clear about that. None of them are sure things. I don't know of any sure things. And I've been looking for 70 years. What I do know is that each of them sits in the path of something real, and that's worth paying attention to. But please, and I mean this with all the sincerity I have, don't buy any of them because a voice on the internet told you to buy them. If you buy them because you've thought about the 3 questions, because you've checked the cash, because you understand the river they're sitting in, because the price feels honest to you, and because you're prepared to sit with them through the hard months without losing your head. That's the whole game. It always has been. I appreciate you spending this time with me. Go slowly, think clearly, and take care of yourself.